Hey guys, how you doing? This is Ryan Michaels, and today we're going to talk about sensitivity analysis and capital budgeting. A little bit about myself involved in my background. I currently hold a bachelor's degree in criminal justice. I've been in the Air Force for roughly 23 years. I currently hold the rank of Master Sergeant, and I'm also a field training officer within Las Vegas Metropolitan Police Department. Let's go ahead and get started. Our first slide is going to cover sensitivity analysis and how it examines how variations and factors influence project results using analytical modules. Ideally, the importance behind this is it helps in understanding uncertainty and risks associated with certain projects that each company or corporation may encounter on a daily basis. A reference for this material is going to be Tesvaca and Oquardo, 2021. Our next slide is going to consist of discussing qualitative steps in sensitivity analysis. We're going to identify key variables affecting the project. In capital budgeting project, there are several key variables that may affect the outcome. Some of the key variables to consider for a sensitivity analysis include the following. Initial investment, which is the amount of money required to start a project. Cash flows, the estimated cash inflows and outflows over the project's lifespan itself. Discount rate, the rate used to discount future cash flows to their current present value. Project duration, the length of time over which the project's cash flows are estimated. Inflation rate, the expected rate at which prices will increase over time. Revenue growth rate, the expected rate at which the project's revenue will grow. Operating expenses, the costs associated with running the project, and assessing the potential range of values for each variable in itself. Our next slide will discuss quantitative steps in sensitivity analysis. The impact of variable changes. Great example, you could create a financial model to simulate the impact of changes in interest rates on a company's borrowing costs. By adjusting the interest rate input in the model, you could see how the company's overall financial performance is affected. Calculate the range of outcomes for different scenarios. You could calculate the range of outcomes for a new product launch by considering various scenarios such as different sales volumes, pricing strategies, and production costs. By running different scenarios through a financial model, you can determine the potential range of outcomes for the project. Building a sensitivity table or graph to visualize the results. For instance, you could also build a sensitivity table showing how changes in raw material prices impact the profitability of a manufacturing business. By varying the input for raw material prices and observing the corresponding changes in profitability, you could visualize the sensitivity of the business to fluctuations in raw material costs. Calculate metrics like NPV, IRR, and payback period for each scenario. Calculate the NPV, IRR, and payback period for a new investment project under different scenarios. By adjusting key inputs such as initial investment, cash flows, and discount rates in the financial model, you can calculate these metrics for each scenario to assess the project's financial viability and compare the outcomes. Our next slide is going to consist of risk incorporation and capital budgeting. Risk assessment, consider external factors like market conditions, competition, and regulatory changes. Risk-adjusted discount rate, use higher discount rates for riskier projects. And then sensitivity to risk. Project outcomes can be evaluated by how they vary with changes in risk factors, and each security is allocated a risk budget defined by a downside risk measure. Reference for this material is going to be G and Lejeune, 2018. Our next slide will consist of project risk management. Risk mitigation strategies usually involves diversification, insurance, and contingency planning. Risk monitoring, which is utilized to regularly update sensitivity analysis based on changing risk factors. Risk reporting communicates findings to management to make informed decisions. Integration with project planning ensures risk assessment is part of project planning from the actual start. And in conclusion, with our final slide, sensitivity analysis is very important within capital budgeting as it helps managers evaluate the impact of uncertainties and changes in key project variables on the project's financial outcomes. By conducting sensitivity analysis, managers can assess the potential risk associated with a project and make informed decisions regarding its feasibility and profitability. It is absolutely vital to continuously conduct risk assessments in order to make well-informed investment decisions. By regularly evaluating and managing risk associated with investments, you can adapt to changing market conditions, anticipate potential challenges, and mitigate negative impacts on your portfolio. Ongoing risk assessment allows you to stay ahead of the uncertainties and make strategic decisions that align with your investment goals. Remember, being proactive and diligent in assessing risk is key to successful investing. My final slide involves the references that we utilized today for all the material that we covered. If you have any questions, please let me know, and thank you for your time and have a nice day.